Monday, June 5th, 2023, Monaco 64, home of alternative economics and contrarian views. We're going to go over Libor today. Libor is supposed to be phased out at the end of June. And why do I say supposed to? Well, because it was supposed to be phased out at the end of 2021 and it wasn't. And I think it could cause a lot of trouble in the financial markets, and we're starting to see that, of course, in the banking sector in the US, and it could very easily spill over into the UK, into Europe, into many other places. Before we go into what's going on right now, a little bit about Libor and the basics, what Libor really means. Well, Libor means, first of all, London Interbank Offered Rate. There's also a LIBID, is the London Interbank Bid Rate. So let's say I'm JP Morgan Bank in London and I call Barclays. I'm the dealer for Eurodollars, let's say, because there's also a Euro Sterling. People used to trade all currencies in London, and Libor is not just a dollar rate. So I call the Barclays dealer and say, where are you overnight money? And he'll quote a bid and an offer. The bid will be where he'll borrow at from you, and the offer is where you can borrow from him, or he will lend to you. So that's all it is. And this lending is just not collateralized. It's not like a repo where you sell them a treasury security and then buy it back the next day at a little difference. This is just uncollateralized, unbacked lending, and this Libor rate is usually just above the Fed funds rate or the Bank of England base rate or the ECB base rate. When the euro was created, they created something called Euribor, but there used to be the Euromark, there used to be Euro French franc, Euro lira, and they were all Libor rates. And I also recommend you go into my derivatives file because that's very important. Derivatives are a huge market, of course. They're basically used to hedge underlying securities, but they've become like a casino because speculators, hedge funds, and even banks, they use it to speculate, not just to hedge. And it's usually very leveraged, and it's off balance sheet. And let's say you want to bet on $1 million, you only have to put like 50,000 down. That's how the derivatives work. And usually there's a margin account. If your position goes against you, the bank, your counterparty asks for margin. And derivatives, we don't even know how much there are out there notionally. Some people say it's 600 trillion. Others say it's over a quadrillion, which is 1,000 trillion. I think the latter is more correct. The BIS, after the 08 crisis, they changed the accounting for derivatives to make it look smaller. And what's Libor got to do with derivatives? Well, a lot of derivatives contracts, especially in interest rates derivatives, what you call interest rate swaps, and they are the biggest kind of derivatives. I think they're probably more than 2/3 of all notional derivatives. When people deal in them, and they deal mostly over the counter, not in an exchange, so regulators have no idea what's going on in these markets. Well, they reference Libor. A lot of times Libor is used to do deals in derivatives. They will usually say, well, I can swap this bond for you, this fixed bond for 6 months, you know, and we're going to charge you Libor plus 50 basis points. So Libor is like a reference rate for a lot of derivatives. And it's also a reference rate for a lot of loans, not just in London, but throughout the world, and especially in the United States, like consumer loans, mortgages, commercial real estate. So it's basically asking the bankers to change from driving on the wrong side like we do here in the UK. Some of the American viewers say, oh, you were driving on the wrong side. Well, we drive on the left side. You drive on the right side. For us, you drive on the wrong side. But it doesn't matter. So it's like asking the bankers to change the side they drive on, or going to you in the States and say, oh, you got to start driving on the left side. It would cause a lot of trouble unless you did it over a long time. You phased it out, and that's all Libor, the Libor transition means, in my opinion. You might want to comment down in the comment section. You might know more than I do. Yes, the Fed, the Bank of England, and others have tried to go into other kinds of reference rates. SOFR in the US, SONIA in the UK for sterling. But it's been a tough transition because people get used to driving on the right or on the left, and they don't want to change. And that's what it's been all about, I would say. So we'll have to see if there will be an accident. And it looks like a lot of loans are still based on Libor, according to Ernst & Young here. It says, this is from February 2023, Libor transition, where do we stand ahead of the ultimate cessation date in June 2023? So if you scroll down this article, it says that US dollar Libor cessation says 14% of lenders answered that most loans will fall back after US dollar Libor cessation, raising the potential possibility of a redemption traffic jam in the final months prior to Libor cessation. And it's interesting because the present governor of the Bank of England, Andrew Bailey, he was head of the SEC equivalent in the UK called FCA. And when he was head of the FCA, he traveled to New York to speak to SIFMA, which is the Securities Industry and Financial Markets Association, and to warn about preparing for the end of Libor. So you can see here, I'm going to put this article below in the description, and he explains how Libor, the reference rate, is used for many loans, mortgages in the US. And that's why I'm thinking with what's going on in the banks, regional, smaller banks, and even the too big to fail, and the fact that they're trying to get rid of a lot of performing commercial real estate loans before the end of June. That's the excuse they give, is that they want to cut off their losses. But could it be related to Libor? And that's what we need to keep an eye on, because a lot of derivatives as well, we don't know if it's 200 trillion or a quadrillion or 600 trillion will be affected by this phase out of Libor. And yes, what else could hurt the financial markets stability vis-a-vis Libor? Well, volatility, liquidity, and we've heard that the US Treasury market, which is supposed to be the risk-free market in the world, the safest market, has had problems with liquidity. And I think a lot of it has to do with this Libor situation. And why have they decided to phase out Libor? Well, because back during the 08 crisis, Libor rates went through the roof. They went way above the Fed funds rate. That happened when all the banks were collapsing, when Lehman collapsed. And I remember sitting at my dealing desk in the city, and we were all saying, who's going to be next? Morgan Stanley, Goldman Sachs, and we said JP Morgan is going to be the last. And so Libor rates spiked because banks JP Morgan wasn't comfortable lending even overnight to Morgan Stanley and so on. So LIBOR rates spiked, but that created problems for the whole derivatives market, for the whole system. It accentuated, it's like snowballed all the problems. So years later, it came out that the Bank of England, who's supposed to regulate the banking sector in London, supposedly, told banks like Barclays to basically lie about the rate, to tell their dealers to say that LIBOR was 2 or 1%, even though they didn't want to lend to the banks at 2 and 1%. And of course, they've said that they never told them to do that, but the way they spoke about it, it was like a nudge. And there's even an article which I've covered in my videos about LIBOR, and I'll come to that in a minute. This is an article from 2017 from The Guardian, and it says, BBC to air recording that implicates Bank of England in LIBOR scandal. Panorama says it has recording of a 2008 call in which Barclays bankers discuss alleged pressure by Bank of England to lower rates. So there you go. Of course, the Bank of England didn't get in trouble. Barclays didn't get in trouble. They all covered for themselves. I think it's the old quote or adage from the former European Commission president. I even forgot his name now. That's how charismatic he was. But he said, when things get really bad, you have to lie. So LIBOR got tainted, but the bankers continued to use it, and that's why they wanted to phase it out. So before we go to look at the markets, just wanted to let you know the videos I did about LIBOR. Well, I did one in 2017 in April. Bank of England implicated in LIBOR rigging, says BBC, so I cover that. April 2018, LIBOR OIS spread and the derivatives time bomb. 2018 in May, early market update and the look at LIBOR and the Petro Yuan. I was talking about a Petro Yuan back then in 2018. 2020, February, just before everything kicked off. And of course, the 2020 crisis was a good excuse to extend the date of end of 2021, of course. Will there be another excuse in the coming weeks? We'll have to wait and see. I said LIBOR risks disrupting 400 trillion derivatives and loan markets. And I was being conservative, of course, with that number. And then October 2020, LIBOR and the 80 trillion softer big bang. So there you go.
With rising inflation, bank failures, and massive layoffs across multiple sectors, the future of the economy remains uncertain. It's no wonder the central banks have been getting prepared by stockpiling gold. At ITM Trading, we have spent over 27 years building a team of seasoned researchers and analysts who can help you prepare for any financial crisis. Our experts are ready to provide you with proven strategies to safeguard your wealth and assets in the event of an economic downturn or currency reset, which is frankly inevitable. Don't wait until it's too late. Schedule your free gold and silver strategy call by clicking on the link in the description below.
So it's 8:44 a.m. London time. Let's see where the markets are. We got spot gold down about $8. We're trading at 1940. So gold's still under pressure. The spot or the banker's price, I would say. The high's been 1953, and we're right near the low here. Silver's down 20 cents at 23.40. On the lows, the high's been 66. Dow futures up 41. Nasdaq is down 16. S&P is unchanged. Sterling is down 0.5%, 123.97. The euro is down just under 0.2 at 106.92, and the dollar is up above 140 versus the yen now. It's up 0.33%, and the dollar is up slightly versus the yuan at 712.94. Aussie dollar is down 0.2, just below 66. And the dollar is unchanged versus the Canadian dollar at 134.30. The Kiwi dollar is down 0.2 at 60.48. To the general commodities, we've got WTI crude up 2%, over $1, almost $1.50 higher. I see OPEC wants to cut production by another 1 million barrels, so we're at 73.15. Brent crude is up just under 2% at 77.50. Platinum is up $1 at 1,007. High-grade copper is down 0.25% at 372.50. And we'll quickly check the bond markets before we tune off. The 2-year gilt yield is up 10 basis points at 4.46. The 10-year is up 8 at 4.24, and the 30-year is up 10 at 4.57. So the UK government bond market is not out of the woods. The higher the yields go, the worse it is for everything to do with finance, of course, and mortgages, credit cards, because it will be reflected in higher rates. U.S. Treasury market, we got the 2-year up 6.5 basis points at 4.56. The 10-year is up 5 at 3.75. So why are the bond markets coming off and yields going up? Well, we had a strong non-farm payroll on Friday, U.S. jobs data, even though the unemployment rate rose, and people think that the Fed might still be raising rates on June 14th. They think the Fed will have to stay fairly hawkish because supposedly the economy is doing great, you know, and these non-farm payroll numbers are showing it. Even though non-farm payroll is just a survey, they don't really count how many people are working. It's just a survey, a national survey. And there's another survey, the household survey, which basically said that 300,000 jobs were lost, and that's why the unemployment rate went up. So it's all very confusing. It just adds to more and more uncertainty. And adding to that, we've got the Libor, of course, phase out that's supposed to happen by June 30th. So with that, I'm going to wish you all a very good day and a very good start to your week. Take care. Bye.